One thing which I have seen in Narnolia 3T PMS is that you guys are different in the context that you take cash calls. Right? It's not that on day one you will deploy the entire corpus, right? Unlike some of the other funds who deploy in one go. So also I have seen that you do some tweaking with allocations. So how would you explain this particular aspect? What gives you, so I think maybe you, because you're doing so much research, you're managing each portfolio in a very customized way, right? So would you like to explain this particular aspect?
Okay, let me take the cash thing first before we go to allocation. What are basically edges there when we meet our customer, and PMS is a very customized portfolio for each of the customers, so we don't have a very generic one go, one fit for every of customer. Largely the scheme remains same,
right?
But our first job is clearly identifying the risk and the return possible for every asset classes, and letting the customer know very clearly how things are. Now once that customer gets aware and takes a conscious risk reward decision, then for each of the asset classes, maybe equity for example, so if in the equity, once he's aware about the risk return characteristic possible, then we advise them or we ask them, you want to put all your money in the equity right now, which depends upon a function of what your own risk appetite in the market is. The other way is advising somebody to stagger the money in 3 months to 1 year time frame. So it's a very customized, for some customers like all deployed one go, depending upon what the customer own risk return characteristic understanding is like. So I can tell you about a very asset class where I'm thinking gold is moving, where I'm thinking rupee is moving, where I'm thinking large cap is moving, where I'm thinking pharma is moving. But once you are aware about the various asset class possible, whether the physical assets or the financial asset, and in the financial asset all kind of a financial asset, then it becomes very easy for a customer to take a very prudent allocation call. And inside the allocation, if a timing is required by customer, we surely always welcome and handle in a staggered manner. Some client go for 3 months kind of a stagger, some even go for 1 year kind of a, and we always welcome that decision. Because see, my role is more to get my customer know my perspective on various asset classes, right? It's not like 0 equity and 100 cash or 100 equity 0 cash. Now those are the situations you face very rarely in your investing lifetime. Say I'll give you an example. You want to go cash when you feel your principal will not come back, say in 5 years also. Because market is non-linear. Market will never give you a fixed percentage return every month, quarter or a year. It's a very lumpy kind of a payoff from equity investment. So I know 1 year something can happen, 2 years something can happen, but I will have a limit to how many years of adverse situation I want to, still I'm okay with my portfolio, right? So you decide that, or you decide the market peak. So somebody say, why don't you sell at peak and go cash? My understanding is you have to define first the peak. What is the peak? Every day, intraday, there is a peak in the market. Yeah. Is that the peak for you? So you will have a perspective. For me, a peak is the one from where the market for 5 years will not make a new peak. So if that is the horizon you have in your mind, that today, we had a close to 12,100, 200 kind of a peak for Nifty. Now, if your belief is that 2019 the peak was 12,200 and even 2023 this peak will not be broken, then surely you should take a 100% cash call instead of being into equity, right? So that's the perspective. Now, that kind of situation can occur when? If you look at the multiple cycle in the world, a price peak or a market peak happens not because of only valuation peak. Valuation was very high. It happens when the fundamentals were too good. So every market peak, you remember 2000, 2007 or global Japanese market or any other market. So 1989 when the Japanese market made a peak, that time the fundamentals were great there. The earning growth was 30%, more than 30%. Or say in our case, in 2007, think about the kind of so EBITDA margin of Nifty or Sensex was closer to 20%. The ROE was higher than 20%. The earning growth were more than 25% and we made a peak. Right? Market peak happens, a fundamental market peak happens when the fundamentals are too good, right? If there is a too good a fundamental and too high a valuation, then you can be in a situation where for 5 years you might not make any money. But in a scenario like the way where we are or where we were say 3 months back also, the fundamentals were not great. We are all talking about earning degrowth continuously. So if earning is degrowing, margins are at close to say last 5-6 years low. ROE of the broader market is close to say 12%, which is a lower of the basic the band. In that scenario, when the fundamentals are not good, only valuation is high. That price peak is something which will get broken once the earning revives. Because the combination of high valuation and high fundamental gets to a point where the peak is not broken for very long years. So that cash and equity call has to be taken sometime. So like it's not you have to buy and just be with the stock for 20-30 years. You will have in your lifetime couple of occasions where taking a cash call will be very prudent. Right? Of course, we are not there in that market, at least for Indian investor. Right now, I don't see any reason why for every year we will not make a new high. I don't see any reason for this. Our fundamentals are too average or bad, I would say. That only thing which can happen in 3-5 year time frame, which is usually the time frame of our investment. The fundamentals, both in terms of sales growth or a PAT growth or a margin, will be better than where we are today. So if the fundamentals improve in 3 or 5 year kind of time frame, you cannot think of a market where cash call is important. But in terms of risk return on various asset classes, you have to take a conscious allocation call, I would say, not a cash call in that sense.
So what are the positives that you see, at present? Fundamentals, as you're saying, in terms of earning numbers, sales numbers, profit numbers, they're not good, they're bad, and it is reflected in the broader market indices. But what are the positive factors that you see, which make you feel confident where you're saying parallelly that, there is no reason that Indian equity market should not make new highs?
Right. Okay. So see, there are two things. How the next cycle will start. That's the I think key thing for in our mind, right?
Yeah.
There are two things. What has brought us here? If those forces weaken, you build a base for the next rally. So that's the first thing is what has brought us. Say like maybe say 1.5 year of bear market in India, not in Nifty but in broader market. The forces that played a role in that. Once those forces start weakening out, you can start thinking in terms of some base building in the market. And then you need a trigger which will take you to the new trajectory. So this is ideal how the cycle turns, right? Look at where we are today. I think close to 75% listed company in India are down by more than 25% on say 1 year time frame. Many of the funds, PMSes and other, also are down in some kind of a bigger number. Fortunately for our PMS, we have been able to resist this fall to a large extent. Now, what has brought us here? Look at it this way. And are those forces which brought the market to a level like this, are those forces weakening or not? We all agree the credit cycle is what is giving a pain in the market right now.
Yeah.
Now let's divide trade cycle into a couple of sub parts. One, your NPA cycle in the banks, because banks are either do not have ability to lend or do not have willingness to lend.
Yeah.
Primarily because of NPA cycle. Then you have liquidity constraints, the liquidity cycle, and then the credit itself. Look at NPA cycle. So between 2014 and 19, or I think 18 end, total NPA for Indian banks were 18.6 or something lakh crore. So almost 18.5 lakh crore of NPA asset got built in India. What was the total loan book of India in the beginning of 2014? Only 65 lakh crore. So out of 66 lakh crore lent in the market, close to 18.5 lakh crore became NPA. Now, today the total advances of the banks is 100 lakh crore. And add all the news that we are listening about this company going default and that company going default, add the number, it's hardly 2 to 3 lakh crore. So on a lending base of only 67 or 66 lakh crore, 18.5 lakh crore went NPA, still our banks have survived, many of those, particularly the private sector name. Now at 100 lakh crore of base of lending, 3-4 lakh crore will not be a difficult if you look at the near past only, right? So NPA for sure has peaked some quarter back. The problem is the large NPA, that 18.5 lakh crore of NPA, was from few corporates. So the noise was less. Now this 2 lakh, 3 lakh crore of NPA, possible NPA, is from many number of corporates. So the noise are more. The value is less, but the numbers are more, so there is more noise. But practically for a bank, what matters is not number of NPA account, but extent of an NPA account, right? So NPA cycle is now over. To my mind, we have seen the worst of NPA. From here on, of course, in the last 2-3 quarter itself, if you look at the number, the NPA slippages has reduced substantially, and I think from here on it will be continuously reducing. That's one part of it. Look at liquidity cycle. So 2018 July August, when the IL&FS crisis happened, the whole money market became almost a fridge. So no bond was issuing, no one was interested into a bond, and we got into a kind of a liquidity cycle. So remember, every analyst in 18, the whole of second half of 18 was calling about RBI should do more of OMO, open market operation, and RBI did a humongous amount of OMO between October 2018 and March of 2019. For last 4 months there is no OMO. Since June, the liquidity is surplus in the system. So your NPA cycle is over, your liquidity cycle is over. So the problem which brought the market to a level where so many stock has fallen so much, the reason behind those problem with the cycle has receded a lot. Credit cycle still remains broken. Why? Because those who can afford to, those whom banks are willing to lend, they are not willing to borrow, and that segment of the market or the economy which are interested into more borrowing, banks are not willing to lend. So it's kind of a lock between a willing, non-willing banker and non-willing lender. So that's a kind of a lock. Now whether this lock will remain for a very, very long time, no. We have already passed the NPA cycle. We have already passed the liquidity cycle. This is the last piece of the puzzle which has to get solved, right? So 2/3 of the problem is already over. Okay. So maybe the market also, the whole fall 2/3 is over, or maybe more than 2/3 is over. We are towards the fag end of the problem. Now this problem, fag end means, doesn't mean tomorrow is going to go end. It might take another 2-3 quarters, or maybe another 3-4, or maybe more than 2 quarters. But look at it this way. Next budget is just, how many months? 5 months away.
Yeah.
And the kind of feedback loop which is going back to the government from industry in terms of what is happening there is going very rapidly. We all aware about this. So there is a good amount of chance that government intervention will make, so naturally if this cycle, the bad cycle has to end in 1 year, because of the positive intervention, the cycle might end in only in 3 to 4 months. So why I'm talking about, see, I'm not believer in terms of government intervention. Market always, it's like, always takes its own balance and it starts a new cycle. What government intervention does is shorten the pain period, right? So I hope something can happen. So maybe 2 quarters you can think about a pain, or maybe 3 quarters at the max. But where we are, the forces which were trying to make things problematic for India has receded almost. So 1/3 pain is there. In terms of newer cycle, look at it this way. Every bank is in the business of lending, right? Right now they are lending only to AAA borrower and getting a 9% kind of yield, 8.5-9%. Whereas AA minus can give you 10.5% yield. But even the banker is not willing there. Once for few quarters they make good amount of cushion of the profit, naturally 3 quarters down the line, the same credit manager will be willing to lend to AA minus, and the cycle from AA minus to AA, and then will simply move on. So the credit cycle by default, as a natural cycle, it starts moving in. We are towards the end of the problem of the credit cycle, and things will start. Whether the government intervention will make sure that the journey starts early or it will take couple of months, is that the only question mark, I think. And then from there on, we'll have another structural bull market.